Good morning and welcome to the Killik & Co market update. Inflation is still a key focus here in the investment world, and this week US inflation came in at 6.2%, which is a 31-year high. Central banks around the world are still insisting that inflation is transitory or temporary, but some economists are starting to worry about persistently higher levels of inflation. Here at Killik, we look at lots of different inflation indicators, and some of these that have been heading higher over the last few months are now starting to look a bit more mixed, which does imply that perhaps inflation is starting to peak. So let's have a look at some of these bits of data. The first one is the gold price. Historically, gold has been seen as an inflation hedge because it is a physical asset, and historically investors have bought gold in times of higher inflation. However, in recent months there has been some speculation that investors have been buying cryptocurrencies instead of gold as an inflation hedge. Whatever the reason, gold has certainly become more volatile over the last year, as you can see by this chart, but in recent weeks it has certainly started to rise in price, so that could imply expected higher rates of inflation. The second piece of data is the 2-year Treasury yield, which is taken by some economists to show the expectation of future inflation. You can see this has been rising over the last few weeks, but last week it did have a bit of a wobble, which does imply that perhaps expectations are becoming a bit more mixed. The final piece of data, and in my view the most interesting piece of data, is the Baltic Dry Index, which shows the cost of transporting dry goods across various different shipping routes. In the year to October, this more than quadrupled, and that has certainly led into the higher inflation numbers that we're seeing at the moment. However, over the last few weeks, the index has plummeted, as you can see by the chart. So if shipping costs are starting to come down, that could potentially allow these inflation figures to come down too. So we'll be watching very closely to see how November's inflation figures look. And also this week, it was interesting to note that PayPal shares dropped by more than 10% following the publication of the company's results, despite the fact that the company published double-digit growth numbers. Here are some charts that we took from PayPal's investor relations pack. You can see that payment volumes grew by more than 24% and revenues were up by 13%. So the company is continuing to grow quickly, despite the fact that the economy is reopening once again. Markets have had a strong run over the last year, and some valuations are seen as being relatively high. So there are some quite strong expectations baked into some of these share prices, and we could potentially see some big share price movements if some results miss these expectations. So potentially we could be in for a period of heightened volatility. Please do give us a call if you'd like to hear more about PayPal's results in detail. And finally, the first draft of the COP26 Climate Summit Agreement has been published, and it has been widely criticised for not going far enough. One of the key issues is that developing countries are still heavily dependent on fossil fuels, including coal, and they need help with their financing to move away towards renewable power, and very little was agreed at the summit to help the countries with this transition. Despite this, the opportunity and the need for renewable power companies remains significant, particularly as Joe Biden's $1 trillion infrastructure package has finally been voted in. We'll take a look at this in more detail next week, when hopefully it will have been formally signed into law. Next week, we'll be looking out for results from Experian, SSE and Alibaba. That's it from us. Enjoy the weekend, and we'll see you next Friday.